On Wednesday, Iran seized 2 container ships in the Strait of Hormuz, and the Nasdaq hit an all-time high the same afternoon. That collision is not a coincidence. It is the defining tension of this market. The Strait of Hormuz was moving 20 million barrels of oil per day before the war. That number is now down to a trickle. Saudi Arabia and the UAE have maxed out their bypass pipelines, but every day the choke point stays closed, the world loses between 10 million and 15 million barrels. Brent crude crossed $102 Wednesday. WTI topped $93. Oil is up more than 50% this year. That number is not abstract. Airlines are cutting flights. Southwest Airlines flagged soaring fuel as a direct drag on its Q2 outlook. The entire airline sector moved lower as fuel costs shredded margins. United Airlines warned that the era of affordable air travel may be over. The inflationary pressure is not limited to jet fuel. The Iran war has already hit helium supply, a critical input in chip manufacturing with no viable substitute. Qatar's Ras Laffan complex, which supplies 30% of global high-purity helium, has been offline since March 2nd. South Korean chipmakers Samsung and SK Hynix entered the year with enough inventory to last through June. After that, the clock is running. Meanwhile, economists are pushing back Fed rate cut timelines. With one-year inflation expectations already running at 4.8%, the war's energy shock is the single biggest obstacle to monetary easing. ServiceNow reported quarterly results Wednesday that beat estimates, but subscription revenue took a direct 75 basis point hit from delayed deal closings in the Middle East, and the stock fell 14%. The CFO explicitly cited the geopolitical environment as the reason for incremental conservatism in guidance. Trump extended the ceasefire Wednesday, citing Iran's seriously fractured government, but Iran rejected formal pressure talks, and its Navy continued seizing ships hours after the announcement. UBS now expects Brent to remain above $90 even if a peace deal is signed, citing months needed to restart shut-in production and years required for damaged facilities to recover.
The reason the Nasdaq hit records on a day when oil topped $102 comes down to one force. AI infrastructure spending has become large enough to override traditional macro headwinds. Google unveiled its 8th-generation tensor processing units Wednesday, 2 distinct chips, the TPU-8T for training and the TPU-8i for inference. The split architecture is significant. Google's reasoning: with the rise of AI agents handling complex multi-step tasks, the computational demands of training and inference have diverged enough to require specialized silicon. The TPU-8i combines high-bandwidth memory with 3 times the SRAM of its predecessor, directly targeting the latency bottleneck in multi-agent AI workflows. Google claims 82 forces are now running in opposite directions at the same time. The AI infrastructure cycle is producing a wave of earnings beats that is lifting the broad market. The Iran war is producing an energy shock that delays rate cuts, squeezes margins, and is starting to appear directly in software revenue. Wednesday's session showed both playing out simultaneously, with tech equities overriding the geopolitical drag. For now, Tesla's earnings illustrate the tension. The company beat profit estimates and reporting $1.4 billion in free cash flow, but revenue missed, and the stock gave up its after-hours gains once the earnings call revealed capital expenditures would top $25 billion this year, $5 billion above prior guidance. The AI pivot, Optimus robots, robotaxi expansion, requires enormous spending before it generates revenue. That math only works if the broader market keeps tolerating high capex in AI. The weight of AVGO points toward continued AI infrastructure dominance in the near term. Over 80